High interest rates, a slowing real estate market, and declining home prices have been the talk of the town lately. But did you know that the average person's mortgage loan is not held by the bank with which they got it? In fact, your loan is probably being passed around the world to different investors. That's right, some of you already know that the bank does not hold the cash that you deposit, but they don't hold the loans that they issue either. They sell them off in order to be able to have more capital to lend out. Hello ladies and gentlemen, it's Makita here with another video today. Instead of talking about current events or the latest headlines, the purpose of today's video will be to go over the mortgage sector of real estate. We'll go over the secondary mortgage market and how it played a role in the 2008 financial crisis. Before we get into it, make sure you leave a like and subscribe. It would mean a lot. And without further ado, let's get right into it. First off, let's go over what the secondary mortgage market actually is. In simple terms, the secondary mortgage market is a financial marketplace where banks and other primary lenders sell loans to investors. The secondary mortgage market allows lenders to free up capital so they can issue more loans. It allows investors to buy mortgages in order to receive interest payments made by homeowners. If you're familiar with Fannie Mae and Freddie Mac, they also purchase mortgages on the secondary market. It is called the secondary mortgage market because it is removed from the original or primary transaction with which the loan was issued for. The primary market price is already set beforehand, and in the secondary mortgage market, the price is, like the stock market, determined by supply and demand. The interest rate you get up front is what the lender decides to give you, and the interest rates the investors get in the secondary market is dependent on how high the demand is for that security. You're probably wondering, why is this even a thing? The secondary mortgage market is important because it allows for the continuous flow of capital in the housing market. It's what makes it possible for people to refinance their loans and for first-time homebuyers to get mortgages. In 2007, before the global financial crisis, the demand for these mortgage-backed securities was high. Investors were looking for a new cash cow after the dot-com crash and stumbled upon mortgage-backed securities. They felt optimistic about the housing market and believed that it would never crash. Over time, the number of people in demand for the mortgage-backed securities wasn't balanced with the number of loans that were being issued. This led to lenders issuing subprime loans just to have securities to sell off to the investors. The problem with this was that a lot of these subprime loans were being given to people who could not afford to pay them. If you had a social security number, you were guaranteed to qualify for a loan. No job, no problem. Just sign here and enjoy your $500,000 loan. Defaults began skyrocketing due to people having these bad loans and no income to make their payments. As a result of this, foreclosure filings rose 81%. So at the time, a major financial and housing crisis led to a recession, not the other way around. Nowadays, people are seeing the market slow down and prices correcting and automatically assume that we're headed for another 2008. But when you actually learn the facts of what happened during that time and that it was borderline a huge Ponzi scheme, you'll realize that it is highly unlikely that we'll see another 2008. Lending standards today are much higher, and the amount of credit available today is a fraction of what it was in 2008. In real estate, there are traditional sales, foreclosures, and short sales. A traditional sale is your typical run-of-the-mill sale with a motivated buyer and a motivated seller. The proceeds from the sale are used to pay off any debts attached to the property, such as the mortgage, and the homeowner keeps any equity. Foreclosure occurs when a homeowner stops making payments on their mortgage and the lender repossesses the home. The lender then puts up the home for sale in order to recoup the debt that is owed on the mortgage. A short sale has to be actually approved by the lender, and the home has to be worth less than what the homeowner owes on it. The lender will want to review recent sales of comparable properties to make sure this is the case. The seller must be able to prove financial hardship. They have to show that they do not have the income or the assets to pay back the rest of the loan. The proceeds from the sale go to pay off the mortgage and any other debts attached to the property. During the 2008 financial crisis, this was also common because almost anybody that bought before the collapse was underwater on the mortgage later. A short sale will have a negative impact on your credit score, but not as much as a foreclosure. Foreclosure will stay on your credit report for 7 years, while a short sale will stay on your credit report for 2 years. In the world of lending, there is also something called a reverse mortgage. A reverse mortgage is when a homeowner who is 62 or older has equity in their home and takes out a loan against the value of their home. Payments on the loan don't have to be made until the borrower moves, sells, or dies, as well as the interest, which is accrued over time. The loan is then repaid from the proceeds of the sale of the home. If the sale proceeds are not enough to pay off the loan, the lender is not responsible for the difference. The homeowner or their estate is responsible for any remaining debt. A reverse mortgage can be a good option for seniors who want to supplement their income, but it's important to understand the risks involved. One risk is that the borrower could end up owing more than the value of their home if the value of the home decreases or if they live longer than expected. Another risk is that the borrower could end up losing their home if they don't make the property tax or insurance payments. If you're looking to buy a home, it's important to understand how mortgages work. So I hope this video was helpful to you in some way, shape, or form. And if so, it would really mean a lot if you hit that like button and subscribe. We post once a week and we do our best to keep you guys informed and updated on current events. All of our socials are linked in the description below, so be sure to check us out. That's gonna wrap it up for this video. I'll see you on the next one. Stay safe and stay informed.